Argentina boasts the second-largest national economy in South America, trailing only behind Brazil. As a developing nation, Argentina stands out for its remarkably literate population, thriving export-oriented agricultural sector, and well-diversified industrial base. However, in recent years, Argentina has encountered significant economic challenges marked by elements such as elevated inflation rates, a substantial fiscal deficit, and fluctuations in the currency exchange rate. Is Argentina's economy about to face the worst? Join us as we take a look at Argentina's economic turmoil. Known for its large reserve, Argentina boasts of an incredible amount of natural gas, oil, and hydropower. This energy-rich country has the second-largest reserve of shale gas and the fourth-largest reserve of shale oil worldwide. However, its current economy fails by the minute. Argentina grapples with an exceptionally high inflation rate, surpassing 140% and steadily increasing. The rapid increase in prices undermines the purchasing power of the currency, resulting in reduced affordability for basic goods and services. Unofficial estimates suggest that inflation in Argentina has been consistently hovering around 25% annually since 2008, a stark contrast to the officially reported figures, which indicate less than half of that rate. This prolonged period of inflation, if validated, would mark the highest levels since the notable devaluation in 2002. Also, during the second quarter of 2019, indications pointed to a deteriorating economic situation in the country, characterized by a surge in inflation rates and the devaluation of the currency. Notably, despite Argentina securing one of the most substantial financial support programs from the IMF, the poverty rate escalated from 26% to 32% within a year. An awful 6% increase that has had an adverse effect on the economic state of the country. In an effort to stabilize the economy in August 2019, measures were implemented by the government to restrict foreign currency purchases. And while this took place in February 2022, Argentina witnessed a notable surge in the inflation rate, reaching 52.3%, marking the most significant increase since September. In response to the escalating inflation, the interest rate was raised to 69.5% in August, reaching a 20-year peak of 70%. This surge was attributed to various factors, including the pronounced inflation uptick during 2021 to 2022, with projections indicating a potential surpassing of 90% by year-end. A significant milestone was reached in February 2023 when inflation exceeded 100% for the first time since 1991. This, in turn, has affected the ability of its citizens to meet essential needs. In addition, this phenomenon tends to induce a reduction in both consumer spending and business investment. The prevalence of high inflation establishes an unstable economic environment that has the potential to impede sustained growth and developmental initiatives. While the issue of high inflation has been fatal to the economy, we cannot just deny the role of fiscal deficit in its contribution to the current economic state of Argentina. Fiscal deficit arises when the government's expenditures exceed its revenue, a situation that has exerted significant strain on Argentina's economy. This imbalance between expenditure and revenue generation prompts the government to seek borrowing to bridge the financial gap created by excessive spending. This in return results in unfavorable consequences, such as escalation of public debt, triggering adverse effects such as elevated interest rates, diminished investor confidence, and restricted resources for vital sectors like education and healthcare. Now, elevated interest rates occur as a result of the constant need to borrow, and lenders tend to charge at higher rates to mitigate perceived risks associated with lending to a government facing a substantial deficit. Increase in interest rates has a cascading effect on businesses and individuals, rendering borrowing more costly. Sectors such as education and healthcare are also affected as a result of diminished allocation of funds. How about how the restriction of resources has ultimately contributed to the main villain, fiscal deficit? Instances of restrictions of resources lead to little or no funding in important sectors, such as healthcare and education, resulting in deficiencies in infrastructure, equipment, and qualified personnel. On the other hand, public debt has also made investors become wary of the government's ability to manage its finances effectively, leading to capital flight and a reduction in foreign investment. This lack of confidence aggravates Argentina's economic challenges. Furthermore, delving into the state of currency exchange rates in Argentina provides insight into the country's economic challenges. Fluctuations in currency exchange rates present numerous economic challenges for Argentina. One significant challenge arises in the form of inflationary pressures. The devaluation of the Argentine peso against other currencies often results in increased prices for imported goods, contributing to inflation. This, in turn, escalates the cost of essential items for consumers, diminishing their purchasing power. Trade dynamics are also significantly impacted by currency fluctuations. A weakened currency renders imports more expensive, adversely affecting businesses and consumers that rely on imported goods. Moreover, it poses challenges for local industries competing globally. Currency fluctuations also make it difficult for businesses to plan and make investment decisions. Foreign investors may exhibit reluctance due to the associated risk, leading to diminished capital inflows into Argentina. Public finances face another challenge, particularly when the peso weakens against the currency in which the country's debt is denominated. The increased cost of repaying debt can strain public finances, potentially resulting in fiscal imbalances. The economic repercussions for Argentina are alarming when currency exchange rates exhibit fluctuations. A crucial consequence lies in the realm of imports and exports. A depreciated currency elevates the cost of imports, impacting both consumers and businesses by increasing the prices of goods. Interestingly, it is without doubt that political instability is also a contributing factor in the country's current economic state. The consequences of political instability extend across various aspects, impeding economic growth in multiple ways. Firstly, political instability tends to usher in policy uncertainty. Changes in government, shifts in political ideologies, and frequent elections contribute to inconsistent policies and regulations. This uncertainty poses challenges for businesses in long-term planning, decision-making on investments, and the creation of a stable economic environment. Moreover, it acts as a deterrent to foreign investment, as investors typically favor stable political climates to mitigate risks. Secondly, the impact extends to investor confidence. Uncertainty and unrest in the political landscape lead both domestic and foreign investors to exercise caution in committing to the country. This hesitation results in a reduction in capital inflows, crucial for economic growth, job creation, and infrastructure development. Insufficient investment hampers the country's productivity, reduces job opportunities, and impedes overall economic progress. Additionally, political instability can influence fiscal and monetary policies. During periods of political turmoil, implementing essential fiscal reforms, such as reducing budget deficits or introducing structural changes, becomes challenging. This can result in unsustainable fiscal policies, elevated levels of public debt, and inflationary pressures. Furthermore, political instability may compromise the independence of central banks, potentially leading to inconsistent monetary policies that affect price stability. International relations and trade partnerships are susceptible to the impacts of political instability. Instability in the political landscape strains diplomatic relationships, hindering the negotiation of trade agreements. Disruptions in international trade subsequently affect export-oriented sectors, constraining market access, and impede the overall competitiveness of the economy. Lastly, political instability often triggers social unrest and protests, disrupting economic activities such as transportation, production, and commerce. These disruptions also deter tourism and adversely impact the service sector, a vital component of Argentina's economy. Although we have seen the consequences of political instability, we also discuss the impact of the global market on Argentina's economic turmoil. The intricate dynamics of the global market pose considerable economic challenges for Argentina. As a nation heavily dependent on international trade and investment, Argentina grapples with various global market factors that exert influence on its economy. A prominent challenge arises from the inherent volatility of commodity prices. Given Argentina's significant role as a major exporter of agricultural commodities, such as soybeans and beef, fluctuations in global demand, supply, and alterations in international trade policies contribute to substantial price swings for these commodities. Consequently, this volatility impacts Argentina's export earnings, its agricultural sector, and the overall performance of its economy. The role of currency exchange rates emerges as another critical factor in Argentina's economic challenges. As a nation engaged in both imports and exports of goods and services, alterations in exchange rates wield significant effects. A robust local currency can render exports more expensive and less competitive, whereas a weakened currency amplifies the cost of imported goods, fueling inflation. Effectively, managing currency fluctuations in the global market stands as an enduring challenge for Argentina's policymakers. The global financial environment and shifts in investor sentiment also cast an influential shadow on Argentina's economy. Changes in interest rates, capital flows, and investor confidence can ripple through to impact borrowing costs, access to financing, and investment decisions. Argentina's capacity to attract foreign direct investment and uphold stable financial markets is intricately connected to the ebb and flow of the global market. Trade policies and agreements contribute significantly to shaping Argentina's economic landscape. Evolving international trade regulations, alterations in tariffs, and disputes on the global stage directly affect Argentina's export-oriented sectors. Participation in regional and global trade agreements, such as Mercosur and the World Trade Organization, offers avenues for market access, but simultaneously presents challenges in terms of competition and adherence to international standards. Lastly, global economic trends and shocks, including recessions or financial crises, have spillover effects on Argentina's economy. As an open economy intricately interwoven with the global economic system, Argentina finds itself susceptible to economic downturns in major trading partners or disruptions in global financial markets, impacting growth prospects, the investment climate, and overall economic stability. Ultimately, the external debt of Argentina is a challenge that has greatly affected its economy. Argentina has grappled with a range of challenges linked to its external debt, presenting complexities for its economic landscape. Here are some of the suspected factors. Magnitude of debt. Argentina's external debt has been sizable, accumulated for financing development projects, government expenditures, and addressing economic crises. However, the substantial debt size becomes burdensome when the country faces difficulties in generating adequate revenue to meet its obligations. Debt sustainability. Ensuring the sustainability of Argentina's external debt is a paramount challenge. When a nation's debt surpasses manageable levels relative to its GDP or export earnings, servicing the debt becomes precarious, raising concerns about default. This, in turn, can lead to heightened borrowing costs, restricted access to international markets, and a detrimental impact on investor confidence. Debt restructuring. Argentina has undergone multiple debt restructuring processes, involving renegotiation of debt terms such as extending maturities, reducing interest rates, or partial debt write-offs. While debt restructuring offers temporary relief, it introduces challenges, including potential adverse effects on credit ratings and investor sentiment. Impact on fiscal policy. Elevated external debt levels constrain a country's fiscal policy flexibility. When a substantial portion of government revenue is directed towards debt servicing, resources for public investment, social programs, and other vital expenditures are limited. This impediment can hinder economic growth and development. Vulnerability to external shocks. Argentina's external debt exposes it to vulnerabilities stemming from external economic shocks. Fluctuations in global interest rates, commodity prices, or shifts in investor sentiment can significantly impact the country's capacity to meet its debt obligations. Economic downturns or financial crises in other regions of the world can further disrupt Argentina's access to financing. Remember to subscribe to our channel if you found this content valuable. We'll see you in the next one.